What is up, guys? Welcome. Crip, no FUD. It has been 4 weeks, and I am back, guys. I am back. Let's do this. I miss everyone. I miss being on YouTube. Had to take a little break, but we're back. Let's do this, guys. Welcome. Happy FOMC meeting day. Let's jump into everything. Troy's in the house. What's going on, buddy? We're going to jump into everything. We're going to talk. We'll talk about some stuff that's been happening, in the last few weeks, why I haven't really been here much, and just the charts. And what do I think? Where are we headed? That's the big thing, is like, what's going on? 4-year cycle still in effect? Did we top out? Are we about to see a super cycle going into 2026? We're going to talk about that. We're going to talk about that because I am on the fence, honestly. I'm on the fence about all this, but I'd love to hear what you guys think. So let's do this. Looks like we got the whole squad in here already. Troy, TJ, my boy, what's going on? Twan, what's going on, bro? I missed you too, bro. I'm back. Flip's in the house. What's going on, bro? I see that. Still staying loyal to the channel. And listen, especially not only to everybody, but to my members. I appreciate you guys. I really do. Don't worry. I know it's been a month, but we're going to be back up and running. Even if we are topped out, and I'm not saying that we are, but I'm saying even if we are topped out, I promise you we're going to have some moves that we're going to be making all throughout, whatever this situation that we're going to be in. We're going to be making money through it out. So don't worry. I promise you we're going to be good. So with that being said, guys, let's just jump right into this, guys. So again, thank you guys so much for being here. I really do appreciate it. We're going to flow through a couple things. We actually have 30 seconds until we're going to get the data as far as the rate cut. Obviously, we already know 90% chance that we're going to get a 25% or 25 basis point, reduction. Why are we getting this? Obviously, the market, or not the market, but the economy needs it. But Jerome Powell is doing this forcefully. He already stated he did not want to do this. So let's see how the market reacts. Now, remember, before we get this data, remember the last FOMC meeting, which was just 6 weeks ago. And even prior to that, we always see some decent moves towards the upside, and then it ends up becoming a dump fest. Keep that in mind. So let's see here. Let's move over. Ethereum's been running today. Ethereum has been running. Let's see here. I don't see anything yet. Nothing yet. Forecast. Not yet. It should be dropping like any second now. So Spencer, what's going on, bro? Ricky's in the house. What's going on? Jay. Bro, it feels good to be back. It really does. Sometimes you got to take a little bit of a break, to appreciate stuff. It's just like work, right? You do it over and over and over, and you're just like, bro. Ugh. Not like with you guys, just, streaming and stuff like that. So if you guys are just joining, we're waiting. We should be getting any second now the Fed decision. This isn't it right here. Okay. All right. So we got the quarter basis point. You guys can see right here. We were previous 4. We just dropped down to 3.75. So we did get the quarter basis point reduction as of now. Obviously, you can see the markets are, we already kind of had it priced in. You can see Ethereum, though, has been doing really well, knocking on 3,400's door. It actually already broke briefly above 3,400. A little bit earlier, but as of now, we did see a little bit of a slide back down, but it looks like it's coming right back up. Bitcoin right now looking, decent. We're still holding a lot of the gains that we did pick up from yesterday. If you guys notice, we did see a little bit of a sell-off from that 94,000, around 94.6 that we did see. You can see a nice little descending channel, obviously a nice little bull flag on the short-term 1 hour as of now. You can see also on this trend on the top of the bull flag, a nice little confirmation. I wouldn't say confirmation yet, but on the hourly, we did bounce on top of that. So usually that does indicate some more of a move towards the upside. Now, the only thing that I would say is what we keep saying. The last couple FOMC meetings, we've seen these quarter basis points, right? But after the fact, it kind of dwindles off, and we end up actually ending the day off in the red. So keep that in mind. Jerome Powell is going to be talking in the next 28 minutes. I think that's going to be the most important thing. Jerome Powell talking, because from what I'm hearing, right? And you guys know I have sources in the White House, right? No, but seriously, what I'm hearing is that he is going to come out and he's going to have more of a hawkish tone, meaning they gave us the quarter basis point, but he's not going to be he's going to basically throw water on anything that's going to happen, right? And what I'm hearing as well is that they're most likely going to indicate that they want to pause for the next meeting, from what I'm hearing. So look what we're having right now. You see a nice little sell-off with the market right now. And obviously we just talked about this, but this is usually typical for a FOMC meeting. I think the only time that we're going to see an FOMC meeting day where we start really getting those times, remember, year ago where we would get some decent days where Bitcoin would rally and rally and rally. The markets would be very happy, is when I think the market does not want to see these little crumbs, these little quarter basis point reductions. We need to start seeing half, 75, maybe even a whole basis point reduction, letting them know that we're serious. Inflation has come down to some targeted spots. The labor market is very weak right now. If you guys are living under a rock, we've done everything, not us, but the numbers have come back what Jerome Powell is looking for, and he's still holding us back as far as these rate cuts. So, but we all know that Jerome Powell is on his way out of here. So, Bill said epic dump loading. We'll see. Troy said, "Commie to the moon." If you guys have any projects that you want to bring up on DeFi, let me know. We'll bring them up right now. What are the plays right now? I know Flip. I know Flip was calling out a play. Let's pull up a couple things here real quick. Bubbles. I think Flip was calling out Night, if I'm not mistaken. It's up 55% for today. You guys can see, majority of the market right now is kind of just sitting in the red. This is the daily as of now. I would say 90% of the market's in the red for alts, top 100. We have Maker, Hype, right? Hyperliquid up 2%. Obviously, Night's up 55%. Meme Core up about 8.8%. OKB, their token's up about 3%. XDC Network, 2%. And XMR, Monero, up around 6.5%, but nothing too crazy, right? Raw, what's going on, brother? Thank you so much for the £2. I appreciate that. He said, long time, buddy. Hope you're good. That's it. Real quick, and we won't even talk about it anymore. I took 4 weeks off of streaming. I honestly did, because the markets weren't doing good. One, I was like, I don't know, you ever get into a funk where you're just like, it's just like you only do shit that you have to do. The last 4 weeks, I have been on vacation, pretty much. I've been on vacation, literally on vacation. I celebrated my birthday, was with the family, stuff like that. So it's like, but like I said, I'm back. We're back. I don't care if the market's doing shit. We're going to be here. All right? So, Ordinals is going to run next bull run. I hope, bro. I have a lot of money in Ordinals, bro. Ricky said all my stuff's down, bro. I'm right there with you, dude. I'm right there with you. I did reposition a couple times on a couple of things here. You guys know I was holding a lot of Mask, right? Mask is obviously on Solana. When we did a couple moves, like a couple of these big moves running up, especially this particular one right here, when we ran up 157%, this was as of like last week, I ended up being able to break out with a very slight profit just because I had been buying in on our way down, but also was buying in while we were down like crazy. So, the market the market cap for this particular project dropped down to $1.3 million, right? And I ain't gonna lie, I was a little scared. I had a lot of money into it, but I was like, you know what? I'm already, deep into this, no diddy. I'm gonna just go ahead, make some big buys while we are down, like very, very down, bring my average down like crazy. And I was like, the next pump, I'm gonna probably reposition myself. It was hard. I'm not gonna lie, it was hard, no diddy, for me to basically sell off somewhere around here, because I didn't catch the exact top, but I basically, when I hit the green in my portfolio, I sold, and I was like, I'll just let it be. It'll probably retrace, just because that's the way the market's been reacting as of late. So I am watching another screen. Jerome Powell is going to be coming out in about 20 minutes, guys. So, but yeah, that's pretty much what I did for that. I did also sell off on my ZBEC. I did sell off temporarily on my ZBEC. I have been waiting to kind of jump back in. I don't remember exactly where I sold off, but I basically same scenario where I pretty much was just able to get my money back. If I made any money, it was nothing to run home to tell mom about. But the point of why I did that was because this was all in the last like 2 weeks. I wanted to reposition myself because you guys know how it's been, right? The last month, it's been kind of hectic. And I'm going to pull up some bigger frames here, but it's been pretty hectic because you're getting different signals here. You know, all the indicators for Bitcoin has basically stated that we have topped out already. We've already topped out, right? 4-year cycle, a lot of these indicators that we're using and stuff like that has basically, indicated that Bitcoin has topped out and that we are technically already getting into a bear market, right? But there are a lot of things on the flip side that are happening that really contradicts the 4-year cycle, right? And this is where I've been so torn, where I'm like, are we still in this 4-year cycle, or are we technically, is this going to be, the market's getting faked out because we think, a lot of us think that we're in the 4-year cycle. We didn't get that altcoin season. People are selling off, right? Just trying to get whatever they can back because they're anticipating a big bear market. And then out of nowhere, 2026 hits, maybe the first quarter, and we start getting massive bullishness in the markets for one more big super cycle. You guys tell me, what do you think? What do you think's happening? I personally, if you were to ask me a week ago, I said I would honestly, the way I was positioning myself, the way I was kind of, just positioning was that we had topped out. I was not very depressed, but I was very disappointed that we didn't really see that blow off top that we've seen in 2017, 2021. We didn't really get to see that blow off top that we normally see in regards to alts, right? But other than that, was really digging around, looking at a lot of stuff, and it was like, well, hold on. We're about to get a new Fed chairman. You already know the government wants to aggressively start reducing interest rates. I don't think that's single-handedly going to bring the markets, keep the markets up. If we're going into a bear market, I don't think that's going to necessarily keep us out of a bear market. But there's a lot of different things that are going on that I think in 2026 that might potentially extend this cycle a little bit longer. And that's where I'm at as of now, right? So I said I repositioned myself out of certain projects. I've bought back in on a lot of these projects at lower prices. I was able to sell, get my money back, and then reposition myself on a lot of projects. A lot of other projects, like someone mentioned ordinals. I'm so freaking down on ordinals. I think my average price is like $13 or something like that. It's just, ordinals is I don't even know where it's at as of right now. We'll pull the chart up, but I those are the type of projects right now that I'm just not even looking at. I'm just waiting for the market to do what it's going to do, So that's pretty much my story. I'm sticking to it for right now. Punk, thank you so much for the happy belated birthday. I appreciate it. How old do you guys think I turned? Spencer, don't tell him. Spencer knows me personally. Like he's a friend. Do not tell him how old I am. How old do you guys think I am? If someone hits it, I will say yes. But if you don't hit it, I'm not saying it. I will give you a clue. You see, these are natural blondes. This isn't gray hair. This is natural blondes. I'm a natural blonde, all right? Punk said 28. Twan said 25. Holy shit, I appreciate that. Oh, Cash 44. Come on, bro. You guys are all over the place. 44? Come on, bro. Spencer, don't tell them that, bro. Punk said, hey, now can I borrow 20? I got you, bro. You need it, I got you. I definitely got you, bro. Troy said 31. I will say Troy's probably the closest. I appreciate the 28 and 25, bro. It makes me feel kind of good, Makes me think I still got it out there. I'm just kidding. I'm just kidding. Spencer said I need 400. Spencer, kick rocks. You ain't getting $400 from me, buddy. You're telling everybody we're secret lovers. Come on. If we're secret lovers, you don't tell anybody, all right? Cash said, no way, you're 33. So listen, I'm going to be honest with you guys. I am. Drum roll. I just turned 39 years old. So that is the truth. I can't even believe it, bro. 39 years old. Bill said either 42 or 69. I can't believe that I freaking turned 39. People still, like, at the gym, they're like, how old are you? I'm like 36, 37. No, shit, I'm 38. This was as of like a few weeks ago. I was like 38. Freaking 39 years old. It's insane. At least I still am like, I'm in my 30s. You know? Twan says, age like fine wine, bro. I know, bro. I appreciate that. You know, some cougar actually told me that not too long ago. She's like, you're aging like fine wine. I was like, girl, you better be careful saying stuff like that, girl. You better be careful. You married? All right. How are you doing, sir? Absolutely crazy. Real quick, just to get back on topic, we are killing some time. Jerome, our boy Powell, he's going to be out in about 15, 16 minutes from now. Fear and greed right now. We're in fear. We're in 30, obviously. I personally think that we would be so much lower than where we're at. I mean, we were in extreme fear as of 2 weeks ago, but we have been slowly coming out of that extreme fear. You can see on the chart here. I mean, it's still, you guys always know, people ask, they're like, when is a good time to be buying in? Obviously, I always say not financial advice, but if you check out the fear and greed, if you're just running off of just that, if you tend to buy when there's fear, obviously extreme fear in the market, and you have patience, usually that tends to be an ideal time, right? An ideal time to buy. Obviously, right now, the environment that we're in, it's like we can be at 30 right now and still today see, a dump, and maybe it wasn't the best time short term to buy in. But I think long term, if you're accumulating stuff right now, even if you're going to hold, for the next few years, I think right now is a decent time. I think we're going to get some better times long term, I think, in these next 6 to 8 months, because I do believe 2026, no matter what, is going to bring a bear market at some point. So Amor said this is his first live that he's caught in months. Bro, we're here every single day. Where are you at, Amor? I'm just kidding, bro. I haven't streamed in 4 weeks. It's been literally 4 weeks. I have not streamed. And I was losing sleep over it. I really was losing sleep over it. I'm not even going to lie with you guys. Let's run through some charts or some articles real quick. I want to talk about some stuff. And then I have on the screen, I'll show you guys right now. Let me go back to this screen real quick. I'll show you guys. We have Powell's stage already set up. You guys can see, but he's not there yet. So let's take that down. We'll hold off and let's look at some things real quick. So Ethereum rises, and Ethereum actually is at 3,400 as of now. Look at this. Pivotals, a big spot, obviously, is going to be that trend. Remember, as we were coming up, 6-8 months ago, 3,500 now is going to be the spot that I think we're going to have massive resistance on Ethereum. If hopefully we can come up and retest it, that's going to be that trend. I'll pull it up real quick before we read that chart. But this is that trend for Ethereum, right? From back to 2021. This is the trend. Obviously, you saw the breakout as of late. We're coming back up to retest that trend since we broke below. So we're at around 3,400 as of now. Let's see here. So Ethereum rises as altcoin season fears eases and select tokens join the move. So sentiment across the market shows a mild improvement today, with the fear and greed index rising to 30, like we just spoke about, after sending much of the past 2 weeks in the lower 20s and briefly touching extreme fear levels that pushed many participants into defensive positioning. Kind of what I was just talking about myself. Bitcoin is trading near 92,000 after a stretch of uneven activity that began in late November, and the steadier tone around the largest asset has created a backdrop in which a small group of altcoins can advance without relying on abrupt flow-driven bursts. So Ethereum extends its climb on firmer market structures. So Ethereum currently trading at around 33.30, which right now it's at around 34, up about 7% over the 24 hours. And the increase is supported by an improvement in both spot and derivative participation, with deeper books and steadier binding in range that had previously struggled to hold during the last week's retreat. Activity across major venues indicates that traders who had reduced exposure during the November drawdown are gradually re-entering positions. You hear that? So where they're saying that there are a lot of people that maybe had jumped out of the market just last month are slowly starting to come back and re-entering positions. Not because of sentiment has shifted dramatically, but because the asset's day-to-day usage and continued demand for block space provide a degree of stability even when the wider environment remains cautious. So you guys can see, and we're honestly, we're going back. If we are going to see, a nice run in the markets, guys, and us get back to where we were at least at, remember, we don't need Bitcoin to get to $200,000 for us to see an altcoin season. But we need Bitcoin to get to some solid numbers, obviously above 100. We would really want to see Bitcoin trading above 100. I would say safely somewhere around 105 to 115,000 would be that range, in my opinion, where the market will be secure again, right, with confidence, and you'll start seeing a lot of money flowing back in to a lot of these alts and DeFi and meme coins and stuff like that. So let's see here. So Monero gains as privacy demand holds steady. So Monero is trading around 404, up roughly around 12% in 24 hours, and the climb aligns with periods in which privacy-oriented tokens have received renewed attentions from commodities that maintain consistent usage regarding of broader sentiment shifts. Mantle, another one that's up, trading around $120, up about 7%. What is this? Tracks layer 2 engagement as liquidity improves. And then altcoin season still out of reach despite signs of relief. So we'll just run through this real quick. What do we have? We have 9 minutes, guys, until Jerome Powell comes out. The rise in the market sentiment and today's scattered gains among Ethereum, Monero, and Mantle demonstrate that the market is willing to experiment with selective positioning, yet the structure of flows suggests that a broader altcoin season remains distant. And basically what that means is we're seeing a select few of alts that are doing all right, right? And the reason is what they're basically stating is that why we're not seeing it across the whole board is because the market is basically they're cautious right now. And don't you blame them? You get on YouTube, and out of 10 YouTubers, you have 9 of them basically saying that we've already topped out, run for the hills, right? And I'm not saying that they're wrong. I would say that none of us really know what's going on. Like I said at the beginning of the stream, if you're looking at a lot of indicators, we've topped out, right? Statistically, historically, we should have topped out. We probably, that's what the indicators are stating. But on the flip side, we have a lot of bullish stuff coming out, a lot of stuff that normally happens, the markets usually rally. And another thing that I'm looking at too is if you think about everything, right? Not just Bitcoin, but you think about gold, you think about, the stock market, S&P, NASDAQ, Dow Jones. The stock market's been sitting right under all-time highs, right? This has really been a crypto thing. Right? Because it's a riskier asset is how investors are looking. But I think if the markets, and I say the stock markets, if we roll around in 2026 and the S&P, the Russell 2000, NASDAQ, Dow Jones, they're all roaring to all-time highs and they're still running, I have a feeling that a lot of this money that has temporarily come out of the market, the crypto space, will most likely come flowing back in with caution, thinking that maybe it's not over with. Maybe this 4-year cycle has, expired. Maybe we're not on a 4-year cycle anymore. Maybe we are in an extended cycle. Maybe the 4-year cycle might be still in play, but this time around, it's been extended an extra 6 months, right? These are the things that when you hear people, they're like, oh, we topped out. You can't say that for certainty, because the way that we have seen this bull market in the last two years has been so ass backwards. I was talking to Flip about this the other day. I mean, the fact that we saw all-time highs before the halving, that's never happened, right? Never happened. We saw that. ETFs, we've never had ETFs in play for any 4-year cycle. We have that, right? There's a lot of things that have happened in these last 2 years that we have never had in any cycles. So to say with certainty that we have 100% topped out and that's it, I can't run with it yet. I can't run with it yet. So Powell should be coming out, guys, in about 6 minutes, and he's usually on time. He is usually on time. Let me join him in the chat real quick. Spencer, let's see here. Troy said, did you look at Kami? I missed it. No, I didn't pull up Kami. I'll pull it up right now. Kami? Like communist? Bruh. Is this on Solana? It is up 93%. Troy. So what I'm going to say about this real quickly, Troy. It is up 93%. Hell yeah. But I mean, look at the liquidity and look at the market cap. It's this project has dwindled down, as most projects do, right? Especially on Solana. And obviously you can see the volume is relatively low as well. So I would just be cautious. I'd be cautious. If you're up in profits, not financial advice, but if I was there, I'd be probably taking profits and running, in my opinion. So that's just my opinion. Don't come after me if you sell and then tomorrow it's at $1 or something. Gina, what's going on, girl? What's going on? Flip said, let's see here. Flip, what do you need to see this next 2 to 3 months to confirm we topped? Continuation of downward movement, right? If we, let me pull up a different chart, but if we see, I'm trying to look for a chart that's not all freaking lined up here. We got 4 minutes until Powell comes out. So, I mean, there's a couple things, that we're looking at here, right, Flip? And now we're going to go back to the last bull market real quick of what happened when it topped out and what happened, after the top. And you can see this is back in 2021, right? This was our top right here at around 69K. And we're looking at the weekly. And you can see as we went down, there were times where you could see this 3-week period right here where it looked like we were going to bounce, right? But we continued to move down, right? After a few weeks, we continued to make lower lows, right? Same thing. We came down. This was probably about 12, 13 weeks later. It looked like, okay, wait, did we top out? Or I'm sorry, did we bottom? Right? Look at this. We had 3 solid weeks of moving towards the upside. We had a little bit of a sell-off. Is this a double bottom? Oh, this is a nice little W pattern, right? I'm just speaking hypothetically. We make another, move towards the upside. We actually make some new highs, not all-time highs, but new local highs. But look what followed, right? So it sucks if and when we do top out, because it's hard. Right? You got to push all your emotions aside. It's hard to really understand, like, is this it? Or is this a fake out? And like I said, I think what a lot of people are running on right now is the 4-year cycle, right? And I don't blame them. We've been talking about that all, for the last 3 years, we topped out somewhere around where we topped out last time, exactly 4 years ago, So that's why a lot of people with confidence are like, no, we've topped. This is it, But you can see, since we've ran up to that 126, we have been making lower lows, right? Lower lows. Now look, we're at a period where it looks, right? We've had, a solid, decent little 2, maybe 2.5 weeks of where we're at right now. I think what we would need to see that we didn't see in the last bear market was we need to see a nice bounce where we break up into the hundreds again. If we can do something like that, I think that will, like I said, that will bring in that caution money, and it'll kind of, a lot of people will be like, you know what, we're probably not topped out. We're probably going for another run. So some areas that we're looking for, I know Ricky has pinpointed a lot of these very well as far as what we need to get to really, at least build some confidence back and maybe, see some money flowing back. 98,000 is going to be the biggest one, I think, as of right now. If we can get to 98K and break above, I think we're going to see a lot of money flowing in because we will have, a lot of people confidently buying back in, maybe with the indication that we're going to see, some more movement towards the upside. And then obviously after that 98, another big area was probably going to be somewhere around this 107. If we break above 107, we're back up and running 100%. If we break above, and I don't mean come up to 107, get rejected and come back down, but if we break above 107, we're back up and running. But if we can't even get to 98, that's the first hurdle. We can't get up to 98 and stay above 98, right? I'm not saying we got to get to 98 and then bounce to 107, but if we can get to 98, and even if we have to, consolidate, find that support, and then eventually bounce up towards the hundreds, that would be ideal. Because remember, like I said, you go back to this bull run, you can see before we got a significant bounce in 2021, Bitcoin dropped about 52%, right? And then we got that dead cat bounce, which led to an even further drop. Let's see what we are at right now. Something tells me we're going to be close to it. We are somewhere around 36. So we haven't seen, as big as a drop yet. And that's why I think if we can really just get ourselves on the show as far as getting back up to that 98 soon, at least a 98, and if we're just consolidating, I think we'll be back up and running for the most part. We can hold that, and then obviously 107 will be the next big test. And once we pass 107, I'll be on here saying the 4-year cycle is fucking dead, 100%. But until then, we have to move with caution for right now, 100%. So, Amor said it's so saddening to hear that 2026 is most likely a bear market without even a hint of an all season. Bro, I think all of us are here. We're all here on the same thing, bro. It's been a little, even though I'm not going to say I didn't make some good money during this cycle that we've been in, right? Because you guys know that's the thing with me, and you guys, everybody that's familiar with this channel, you guys always used to make fun because I sell so early, right? And I'd miss out on a lot of gains, but I'd lock in profits, right? Because I've gone through it all before. I didn't want to go through the cycle. Hopefully it's not the end, but I didn't want to go through the cycle, and if it is, the profits weren't locked in. We got Pally on stage right now, guys.
And squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed
hawkish, pal,
as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated.
Can everybody hear everything good? No echo?
In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5% to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Here we go, guys.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks.
Did you guys hear that? He basically, I'm going to try to turn him down real quick. Remember what we said at the beginning of the stream? They're indicating that they want to pause for the next meeting.
Last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation.
Don't fall for the Toyota talk or the Honda hype. Come take
next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time, so it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the Fomc agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile,
You guys see 77.9% chance now of a pause coming up in January.
we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately, having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
This is Buick Now.
So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I wanted to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman, does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that?
I have a purpose.
Still want to get back to 2% because inflation is relatively stable where it is.
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. if it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation, about the labor market, because the labor market, unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody, they have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing. And it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way, that's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. Longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, How would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record. Yeah,
so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you'll see you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks.
With Whoop,
dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's not it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
All right. Thought that was never going to end. Alrighty. Look at the market. All right, guys. Well, let me make sure my sound's on. We're good to go. So real quick, just a recap, right? Because I was zoning out a little bit. I always do that. The way he talks, it's just like you could easily fall asleep. But basically, what we called before the meeting started, right? I told you guys that most likely they were going to indicate some kind of a hawkish stance, where they were going to give us that little crumbs, their little quarter basis reduction, 25 basis points, but they were going to indicate that they most likely were going to pause reduction in rates coming up at the very least January, right? And that's pretty much what he indicated at the beginning of the meeting. He did state after that, we don't really know. We don't have the data yet, right? That's what he kept saying. We don't have the data yet. We don't really know if what we're going to do in January. So with that being said, let me refresh this. This was up to 77. It's at 75, so it has come down slightly in regards to January's meeting. You can see right here we have 75% chance that we're going to see some kind of a pause. Right now, this obviously can change. If you guys remember, right after the FOMC meeting 6 weeks ago, for about 2 weeks, it was kind of the same scenario where we had majority of the market was indicating that there was going to be a pause. Remember, we called this as well before the meeting because he didn't have the government shutdown was taking place, and they weren't going to have data. That was his stance on it. But eventually, as time went on, we saw that we started to get the higher percentages. The market started to indicate or anticipate that we were actually going to see that 25 basis point reduction. And that's what we've seen today. So all in all, pretty much what we called. He wasn't as hawkish as I really anticipated he was going to be, but he didn't really give us anything solid as far as good news. Like, the numbers, unemployment's at a certain point, inflation has been steadily coming down. It's still kind of the same Jerome Powell that we have been getting for the last 8+ months, right? Same thing. They're unsure. Tariffs, right? We need to put a bingo card like Meet Kevin. He does that where he puts a bingo card, and if you basically play bingo with the words that he says, because he says the same shit every meeting, and you guys have to see it too. It's almost like he was forced today to reduce rates. He doesn't want to, for whatever reason. He does not want to reduce rates. So that's what we got for today. We'll see how the markets react. I think it's going to take a little time for the markets to kind of marinate. Right now, Bitcoin's sitting at around 93,600. I mean, we did see a move up, right? Remember, during right before the meeting, we were at around 92.6. So we did see a nice little move towards the upside around 94.4 so far. I did mark this line because this was yesterday's pump, right? At around 94.6, we didn't make our way all the way up there as of now, right? We did get rejected right before there. As far as the rest of the market, on the hourly, you can see most of the market's in the green, other than Zcash just dropped 5% for whatever reason. But the rest of the market is in green, but it's nothing crazy, right? we're seeing green across the board, but 1-2% other than Night right here is up 13%. Ethereum moved up past that 34. It did actually get up to about 34.50. Right now it is around 34.10, slightly retracing, but having a decent day up around 2.6%. So all in all, guys, like I said, we'll have to just kind of monitor the situation. We'll have to see how this goes. I talked about this earlier as far as what the scenarios that we are kind of in right now. Unfortunately, majority of the market really does think that we have topped, right? And that's what we are against as of now, right? Majority of the market thinks that we have topped, and it's going to be pretty much, we'll have some moves towards the upside, but for the most part, it's going to be lower highs and lower lows for the most part. So we'll have to see how this plays out. I will say for my members, we are going to have a members only stream this weekend. It's going to be pretty important, guys, because I really want to talk about this. Just everything that I'm planning on doing as of now to kind of hedge if we are, topped out, or if we're going to continue to move. Because you guys know, I like I just told Ricky, I did just open up a short as we moved up. I did open a short. We'll see how that plays out. I'll leave it open for now. But I do have a lot of money still in this market. I don't have as much as I did 2 months ago, but I still do have a lot of money in the market because I'm on the fence. I still do believe that we are still going to see a nice move at some point. This market is due for it, whether it's a dead cat bounce, whether it's another, just that one last fake pump. Who knows? But I definitely want to capitalize on that last pump, and that's what I want to talk about on our members only stream this weekend. So I hope you guys are prepared for that. But other than that, guys, as far as with Jerome Powell, that's all he's going to give us for today. And I wish it looked like we were about to start pumping. It really did. It looked like we were about to start pumping. I'd like to see what happens for the rest of the day. The markets are going to be closing in about 31 minutes. So we'll have to see, how the markets are. But like I said, the S&P right now sitting right under all-time highs. The NASDAQ, Dow Jones is up 1.2% today. That's a big move for the Dow Jones. The stock market is doing fairly well. Gold up about 0.6%. Silver has been absolutely killing it at 1.5% for today. And like I said, Bitcoin, we're up about 1%, Ethereum 2.5%, and across the board, you have Solana up 2%. So nothing as far as with cryptos other than Ethereum has really been a big mover for today, But the stock market has continued to do really well. I'm going to close the poll out. Looks like we have 71% of the chat saying that this is a fake pump, and we have 29% saying that it's this is real. This is a real deal, Holyfield. I'm gonna go ahead and end that chat. Let's see here. Ricky said one more dip, and he's saying that I'm gonna close my short, and he's opening up a long. Yeah. Ricky said he whispered easing without saying it. He didn't really mention anything. Like, he did mention the quantitative easing, but he didn't really mention much. They did talk about their spreadsheet and stuff like that, but I don't know if that's what moved the market, towards the upside, but it really wasn't too much. Ricky said when that money printer is pumping, so will the market. Liquidity has been a huge problem. I agree. Flip saying one last chance to get out. Mr. Kobayashi, I hope I pronounced that correctly. He said, "What's up, dude? Do you invest in Midnight, new privacy coin?" I haven't, but Flip's been telling everybody about freaking Midnight. Is that what that is? It's a privacy coin. Let's look it up real quick. I'm gonna be honest. Other than Flip talking about it, I have not been. I haven't done any research on it whatsoever. A $1.2 billion market cap. I will say privacy coins have been doing really well, like Zcash, right? Zcash, I'm pretty sure is a privacy coin, been killing it. Other than this before this, drawdown that we've had. Let me see here. Is this a Cardano-based project? It is. This is from Cardano. That's right. That is right. All right, now I'm starting to remember. I read up on this. That is right. Hell yeah, good for Cardano. Let's see here. So Midnight is a new generation blockchain developed by Charles Hoskinson, the co-founder of Ethereum and the founder of Cardano, that uses zero-knowledge ZK proof technology to offer utility without compromising data protection or ownership, enabling applications that safeguard users, commercial and transaction data, and metadata. Midnight introduces a novel blockchain architecture designed to address key privacy-limiting designs of existing public blockchains, supporting the application that requires a balance between privacy and disclosure. The Midnight protocol combines the use of ZK-proof-based public and private dual-state ledger architecture to protect data with a composite dual-component tokenomic design to protect metadata. Wow, that was a mouthful. No diddy on that, but it sounds great. Privacy coins, privacy tokens have been killing it, and it seems like that's where, just like the article we read earlier, right? We read the article earlier that Ethereum's been doing really well, but a key few projects right now that are having certain fundamentals that the market's looking for have been actually doing decently during this drawdown. Something like this seems like this could be a direction where, the market might, right now when we're not doing that well, you might see some of these projects actually pump, because you have some of the people that are looking at it for, the utility, the privacy aspect, and then you have probably a big swath of people that are probably going to just invest in this because it's pumping, right? They're looking for some kind of avenue to make some money right now because the rest of the market is not doing its best. So something like this could, it already is killing it, but it could honestly continue to move while the markets are down. So definitely, this is a Cardano project right here. Midnight is what they're talking about. If you're looking for it, obviously, I'm not giving out financial advice, but if I was to buy this, I would probably be looking for some kind of a Cardano wallet, right, through DeFi to pick this up. But if you're not familiar with that particularly, they have it on OKX, Bybit. Let's see here. It says Gate. I don't know if that's Gate.io, Binance Alpha, KuCoin, MEXC has it. Let me see here. Kraken actually has it as well. So it's on a lot of mid-tier exchanges as of now. Excuse me. So not too bad. Ricky, no worries, brother. Real quick before all you guys leave, I do want to say thank you so much for everybody. We had 20 plus people in here watching the stream. You guys could have been anywhere else, right? Because there's probably 17,000 people streaming right now. Jerome Powell, you guys were here, and I appreciate that. So again, thank you guys so much for being here, spending your time. Hopefully, we haven't topped out, guys, and I'm not giving you guys emotion, right? Because we can't put any emotion in this trading. But I do hope, that we do have at least one more solid pump ahead of us, guys. Seriously. And if we do, if this is the last time I see you, I hope it's not. Hit that subscribe. But if it is, make sure you guys take advantage of it. Don't let the greed get in front of it, and secure the bag, whether it's just getting your money back, or if you're definitely in the green, secure the bag, right? Because a bear market will be coming at some point, guys, no matter what. I don't think anything or anybody can stop, honestly, bear markets and bull runs, right? We're always going to go through those cycles, whether the time frame might be different, but we're always going to have it. It's always happened in history. It's not going to stop now, right? It's not going to stop now. So with that being said, let me just make sure. Hold on. My boy Twan said, can you look up Arkham Crypt? Hearing a lot about Alert. Yeah, I actually have Arkham already locked in. I meant to look this up before we jumped in. What are you talking about Alert? You're hearing a lot about Alert. Is that a particular project, or? Let's see here. So $10 billion in the $10 billion hyper unit whale is now longing. This was as of 35 minutes ago. Longing $300 million worth of Ethereum, and he is buying more. The Chinese whale trader who called the 10 out of 10 market crashes is now long on Ethereum. That's something to take into consideration, whether it's short term or not. 48 minutes ago, Ethereum whale that deposited $500 million into stable pre-deposit campaign just borrowed another $500 million to put into stable initial liquidity vault. Arkham alert: the U.S. government just moved $6.5 million worth of Ethereum. The USG just moved $6.5 million worth of wrapped Ethereum to a new wallet sourced from crypto seized from Alameda over 2 years ago. Well, we know they're not selling. We know the government's not going to sell, most likely, right? SpaceX, this was 3 hours ago, just moved $94 million worth of Bitcoin. SpaceX just transferred $94 million of Bitcoin. They have been moving around $100 million of Bitcoin every week for around the past 2 months now. Of this transfer, $37.66 million is transferred to a new address, while $56 million was change. Okay. That's pretty much what we have. 4 hours ago, a wallet just deposited $600,000 to Bybit. Let's see here. $257,000 worth of Pepe and $420,000 worth of Aster. Non-realized price to loss across both positions is a negative $700,000. Holy shit. And that's it for today as far as on Arkham. So, I mean, the biggest thing I would say is as of just 37 minutes ago, we have a whale that just opened up a $300 million long on Ethereum. Ethereum's at around $3,400 as of now. So, I will say, we ran up to 94, we'll say 94.5, right? We came back down to about 93.2. And we're back up to around 93.7 right now. So we saw the run up, a brief little drop down, but I mean we're still holding pretty well in my opinion. I was anticipating with what Jerome Powell was saying that we were probably going to fall off the face of earth, but we really haven't. So as of now, the markets are holding strong. So we'll see how this plays out. I am anticipating this most likely will start coming down. We're at 75 market now. We're at 75.6%. This is the probability of a reduction in interest rates. 75% of the market basically is indicating or anticipating that we're going to see a pause. I'm anticipating this is most likely going to come down. We'll probably see a pause in January. Jerome's going to be pressured, right? And another thing I wanted to mention before we do leave too is that the silver lining. I put this in the chat. Jerome Powell, I have no problem with him, right? I don't have a problem with Jerome Powell whatsoever. But, obviously we would like to see an aggressive Fed chairman that wants to reduce rates, a lot faster. I don't know if that's being greedy or what, but we are going to get that at some point in the next few months. Jerome Powell is set to finish his time in the Fed chairman position, and I believe I want to say it's either March or May, one of those months he will be throwing in the white flag. So at some point we are going to see Jerome Powell exit the stage and somebody else will be coming in that's most likely going to be pretty dovish as far as reducing rates. So Midnight Network, the architecture of freedom is rational privacy. I agree. Ricky said, I think I should open up a long on Ethereum. The only thing I will say, Ricky, is be careful, because even though we're reading this stuff right now, right? This was 39 minutes ago that they posted this. We really don't know when the long was actually opened, right? I don't know if it gives us a time frame on here. I'm looking to see. But I wouldn't be surprised from like down here. It says 16 hours ago. That could be something old. But the point of what I'm getting to is this information that we're getting right now could have been this morning, right? And this person could have opened up that long down here and potentially already closed it for a massive gain. So that's the only thing you have to be very cautious as far as, going off of this is basically second, third hand, information, because it's already trickled, through the internet and whatnot. So we don't know exactly when this position was opened. I wish they would give us a time, like this $10 billion hypernet whale opened up a long at, I'm Eastern Standard Time at 3:38 Eastern Standard Time. I'd be like, hell yeah, open it up right now. But we don't know that, so. Ricky said, no guts, no glory. Yeah. Well, hey guys, listen, that concludes everything. I do appreciate you guys so much. I'm telling you straight up, I do appreciate you guys. I'm so happy to be back. I really am. This is where I want to be. This is it right here. So we're here. We're back. Let's hope this market can just continue, right? Because it's fun streaming when the market's doing well. It isn't fun when the market's not doing well. So other than that, guys, make sure you guys hit the like. If you're not already, please hit that subscribe button. Consider becoming a member on the channel. We are going to have a members only stream this weekend. Hopefully we go into the weekend strong. So with that being said, guys, thank you. I hope you guys have a great Wednesday. Tomorrow, I'm going to be at the Bucks game. Tomorrow we have an evening time Bucks game at 8 o'clock. So if you guys are watching the game, look out for me. I will be with the pirate. I will be with an actual pirate is going to be with me. So look in the stands, and if you see a pirate, I'm right next to him, all right? And I'm going to be holding the rum. All right? All right, guys. Have a great day. Have a great evening. Great, midday wherever you're at, and I will see you guys all soon. If not tomorrow, definitely this weekend for our members only stream, and we'll be back, like I said, on our regular daily streams ASAP. All right, guys. Thank you. See you guys.